Welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to figure out where stocks could be headed over the near term. Last week we got a really big report. We had the payrolls report for the month of December. That is the first significant economic report with complete data since the partial federal government shutdown ended. And, it's a little bit of a Goldilocks number. Goldilocks for the stock market in the sense that it was weak enough to keep hopes for further interest rate cuts by the Fed alive, while not being so weak as to spark fears that we're facing an imminent recession. So payrolls increased by 50,000 during December. That was weaker than expected. The economists' expectations were for a gain of 73,000. But the unemployment rate did dip a little bit. It dropped to 4.4% from 4.6% in the prior month. But probably the biggest cause for concern looking through this report is that prior months saw negative revisions as well. So October's figure was revised to a loss of 173,000 jobs. That compared to the original estimate for a loss of 105,000. And if you go back and kind of average everything out over the year, 2025 payrolls averaged a gain of just 49,000 per month. That compares to 168,000 in 2024. So you've seen a very marked deceleration in payrolls growth in 2025. And that's painting this concerning, weakening picture for the economy. But payrolls has kind of been a standout in terms of economic indicators showing weakness. There's been a divergence in other segments of the economy and other economic data reports. One of those includes the ISM Services PMI. Now, the Services PMI, it's constructed so that a reading above 50 points to expanding activity. Below 50 means activity is contracting, and the overall figure came in at 54.4 in December. That jumped from 52.6 last month. But the thing you really want to pay attention to is components within the report. So these reports are constructed by asking a number of different questions about different areas of impacting businesses. So there's prices paid that we follow for inflation. There's asked about employment trends. Well, another one is new orders. So there is a new orders index, and this one's significant because it is considered to be a leading indicator of economic activity. And you had a really big jump in this new orders component last month. It went from 52.9 to 57.9, and you can see we've had this accelerating trend over the last several months now. So the strength that we're seeing in this leading indicator really flies in the face of the weakness that you're seeing in payrolls data, which tends to be a lagging indicator. And I'll maintain again that a lot of the weakness seen in payrolls data, which again is backwards looking, is a result of some of the uncertainty we had around the trade war. Well, that's now well behind us, and these leading indicators are pointing the way higher. Now, take that also in conjunction with cyclical stock market sectors. They're sending another positive signal as well. So small caps were jumping out to new highs ahead of the S&P 500. The Dow Jones Transportation Index is breaking out to record highs. That's triggering a bullish signal that I'll talk about more here in just a moment. This is important because stock prices discount future business conditions, and that means this rally in cyclical sectors is a vote of confidence in the economy, in the earnings outlook. Now, I would also note that earnings growth projections for both the Magnificent Seven and the S&P 500 and the other 493 are projected to accelerate in 2026 compared to last year's level. That's important to keep an eye on because we're going to enter earnings season. So we'll see how those earnings estimates and that outlook evolves. But this week I want to dive into the evidence that's out there. The economy is holding up much better than what that payrolls report suggests, and the factors that are driving economic activity and how they could boost activity further. And I also want to go into these stock market sectors just a little bit that are providing confirmation and why you need to keep a close eye on oil prices right here. Ongoing deceleration in the pace of job gains. We've seen steadily rising unemployment rates since April 2023. Those are the things triggering concerns among economists and has spurred the Federal Reserve to resume its rate cutting cycle. The Fed has cut for 3 consecutive meetings now by 0.25% or 25 basis points, and that has brought the Fed funds lower by 1.75% since Fed funds peaked out in 2024. Remember, there's been 2 rounds really of Fed rate cuts. One that happened at the end of 2024, and one that's been, and then they paused, and now we've had another round with these last 3 meetings. Not only has the Fed resumed the rate cutting cycle, they are back to expanding the balance sheet by purchasing Treasury securities, which boosts financial market liquidity. And all this taken together is helping keep financial conditions extremely loose, and that is correlated with positive and expanding economic activity. So that's what the chart on here shows. This shows the Chicago Fed actually puts this together. It's their measure of financial conditions. This is constructed so that this zero line represents the average historically. When it's above zero, that means conditions are tighter than average. Below zero means they're looser than average. And you can see we're continuing to see this downward track in financial conditions, meaning they're looser than average, which is a positive tailwind for economic activity. So, and this is now at the loosest level. We got to go back to 2021 to find the last time conditions were running this loose. So again, this remains a tailwind for the economy. What's good for the economy and earnings outlook is good for the stock market. So while payrolls data is sparking a concern, other indicators we're watching are holding up or even showing accelerating growth in the economy. There's a couple things we can look at. Initial jobless claims. I'd argue this is a much better way to monitor the health of the labor market. It's a much higher frequency because it's reported on a weekly basis, but initial jobless claims continue hovering near the low end of the historic range. Now we're getting reports that show holiday consumer spending looks strong. A report from Adobe suggests that online spending during the holidays gained 6.8% compared to last year, jumped to nearly $258 billion. And so all these data points, metrics indicating growth has been okay and it's been holding up is showing up in recent GDP reports. So the most recently released GDP report for the third quarter, that showed growth expanding at an annualized rate of 4.3%. So again, that's an impressive number, 4.3% in the third quarter. And now what I'm showing on here, this is the Atlanta Fed, or GDP Now report. It's a tracker for current quarter annualized GDP growth. So this one, is now looking at the fourth quarter, and we had this big jump last week to over 5%. So this GDP tracker is currently pointing to growth expanding at a 5.1% annualized pace right now in the fourth quarter, which if it holds, that follows a 4.3% growth rate in the third quarter. So again, all this evidence pointing to the economy holding up just fine. Now I will, you do want to take this recent jump with a little bit of a grain of salt. It's a big part of it was driven by an improvement in the net exports component that goes into calculating GDP. But even if you exclude that, even if that is a one-time event and you exclude that, growth is still tracking around this 3% level. So again, showing that broader economic activity continues holding up just fine. All right, recent GDP reports and real-time estimates of economic activity, they are surprising to the upside. And that is driving one measure of the economy's output relative to its potential to the highest level in 25 years. We call that an output gap. So a positive output gap happens when economic output is exceeding its long-term potential, and that's what's being plotted here in this chart. These lines are a little bit hard to see, but this wider brownish line, this is that potential GDP, and then this bluish line is how GDP is actually performing relative to potential. Now the difference between those two lines, that's what's being plotted with these blue bars down here. So if you focus on the blue bars and you come over here and look at where we are now, right now the output gap is positive to the most positive really since the end of the 1990s. So the best figure in about 25 years or so, again showing that the actual economy is trending above the potential. Now, that's good news. When you take a step back all in, that's good news. But one thing you need to keep an eye on with that data is that the output gap could suggest an overheating economy if we continue to run at these levels, and that could eventually contribute to inflationary pressures. All right, so we talked about how investors are facing conflicting economic reports on the health of the economy. On one hand, you have GDP numbers coming in better than expected, things like the ISM Services PMI holding up really well, especially when you look at the new orders component. But on the flip side, you've got the December payrolls was weaker than expected. What I like to do when I'm trying to decipher, how's the economy really doing, I turn to cyclical stock market sectors. The reason is very simple. Stock prices discount earnings. They discount earnings and future business conditions. And so that's why we want to look at sectors that are whose earnings outlook would be sensitive to how the economy is performing, and transportation stocks are a great way to do that. So for obvious reasons, stocks operating in the transportation sector, while it be trucking companies or airlines, they're sensitive to freight movements, which can reflect business conditions, reflect consumer spending. So that's why we want to keep a close eye on how transport stocks are doing. And the IYT ETF tracks the Dow Jones Transportation Average Index. And this is a weekly chart on here going back about 3 years or so. And what I want to call your attention to is that this ETF, we had it originally peak out the end of December, selling off into the trade war, so reflecting the uncertainty there, and then rallied back toward the prior highs and just grinding sideways then for most of the second half of 2025. But look at what happened in December, as we had a breakout to new highs, a breakout followed by some bullish sideways patterns. You can see if you were to draw a trend line on this would look like a bullish flag, or actually a bullish pennant pattern. And just last week, we're having another breakout to new highs over that level. So this has been echoed in other sectors of the economy. So this breakout in transports is a positive sign for the outlook for the economy, outlook for the earnings picture as well. So one other thing to watch with transportation stocks now finally breaking out to new highs. So transportation stocks, if you look at the Dow Jones Transportation Average, spent most of 2025 just grinding sideways, and then finally moved out to a new all-time high at the end of the year. That is triggering the Dow theory signal for the first time over the year. So Dow theory, what it looks at is it stipulates that the Dow Jones Industrial Average and the Transportation Index should be moving together. They should be making, if they're moving out to new highs, they should be making new highs at the same time. If one's rallying and the other's falling, then that's a diverging signal. That could be a warning sign on the outlook, but it's bullish when they're moving at the same time. And what the table on here shows, what this chart shows, is it plots how the S&P 500 moves when you have Dow Industrials and Transportation Index at an all-time high for the first time in more than a year. So remember, while the Dow Jones Industrial Average has been rallying, the Transportation Index has been grinding sideways for most of 2025, but up until December, and that upside has really been accelerating over the last week or so. So we can look on here and see, what the S&P 500 has done when you have that type of condition. Just looking out, a little further out, 9 months, 1 year later, you have high win rates, high percent of time that the S&P finishes positive with strong average gains as well. And this kind of plots out the trading days, how the S&P, how the average for returns evolve over the next year on average. So again, getting that Dow theory signal here over the last month or so is another positive sign for the economy. What's good for the economy is good for the earnings picture, which is good for the S&P 500. Another segment of the capital markets that's been pointing to accelerating growth is with commodities. So base metals like copper has been in the headlines, aluminum, these are sensitive to economic trends. They've been breaking out to all-time record highs. I think the next commodity you need to watch is with oil prices. Oil's obviously been in the headlines lately, especially with the U.S. military operation inside Venezuela and what's going on there. We have ongoing tensions in the Middle East and unrest in Iran. Well, but overall, the news cycle, the headlines have been mostly bearish for oil prices, whether that's President Trump's desire to see more drilling, more production to push oil prices lower, the developments inside Venezuela to help release more oil supply to the market. We've seen OPEC really increase production significantly over the past year. And so the news cycle has been bearish, and that's pushed oil prices near their lowest level in 5 years, but it could be a bullish positioning catalyst evolving. So in terms of positioning, institutional investors, look, they have some of their most bearish bets on record. If you look at short positioning in oil futures, they're near record levels. But then you got this as well. This is a survey of clients by Goldman Sachs, and it's asking institutional investors across asset classes, and then specifically on oil, if they're slightly bearish or outright bearish. And you can see the outright bearish, the black bars on here, really starting to jump over the past year. And in the most recent survey, if you look at the percent of their clients surveyed with slightly bearish or bearish views, the total was pushing up to one of the highest levels we've seen in nearly a decade. So again, this I would look at this as a contrarian indicator. When you look at everything right now, the headlines are bearish. The sentiment. So this is a sentiment survey. The sentiment survey is bearish. The positioning in oil futures looks bearish. I would take all these things in conjunction and together to say that this could be, it's so bad it's good for oil prices. And keep in mind too that oil tends to move very late in the economic cycle. So watch for these things to emerge as a tailwind for oil prices this year. So the U.S. dollar had last year in 2025, the U.S. dollar index, DXY, that tracks the dollar against a basket of other currencies. At one point last year, it was having the worst year since the early 1970s. Then it stabilized in the second half, still turned in one of the worst years going back about a decade or so. But what's interesting to see is how the dollar's movement is closely correlated to how its role in global reserves is evolving. So that's what the chart on here is looking at. It's looking at the weight of global central bank reserves in the dollar versus other things. So we've got the dollar as the black line on here. We've got euros, yen, the pound, but then pay attention to these gray bars, the gold that's being held, percent that's being held in gold in terms of global reserves. And so you can see, really, if you just want to eyeball the black line on here and that proportion that's in gold. And more recently, what I would call your attention to is we had for at least DXY, we had a top in DXY, a local top back in late 2022. Kind of right around this period. This is when DXY started to sell off, so you can see that corresponds to the dollar's falling role in global reserves, the weight that's held in dollars in global reserves. Trailing off, that really picked up into 2025, and gold has been soaring. So, I mean, this is obviously a big driver, a big catalyst behind the weakness that you saw in the US dollar index last year and the rally in gold that we are seeing as well. So keep an eye on this trend as a catalyst and a tailwind for gold prices, a headwind for the dollar to continue in 2026. All right, so got some key economic events coming up this week. The one that I would really keep an eye on is with inflation, is with the CPI, especially the year-over-year headline figure. Most recent report, we had a dip. We'll see if that holds up. But right now, the forecast is to match the prior report, to come in at 2.7% on CPI. And this is important because this follows what we just had with the payrolls report. So the anticipation is that the Fed will continue cutting rates this year. I think right now about 2 rate cuts are being penciled in as the Fed tries to balance its dual mandate of full employment along with price stability. Well, the full employment portion of the mandate, if you're looking at the payrolls report and unemployment rate, that's some cause for concern. But usually when you see that happening, inflation is not too problematic. But we've had inflation holding near, on a year-over-year basis, near the 3% level, which is well above the Fed's 2% inflation target. So really keep an eye on CPI, how these inflation trends are evolving, and if that can support the outlook for additional Fed rate cuts. All right, one thing I want to keep an eye on next week is with stocks in a high growth theme. So we had a number of these themes working really well last year into late summer. Since about late October, These gains in these themes have been tougher to come by, but just over the last week or so, really since the start of 2026, we've seen a number of high growth themes, call them emerging growth themes, are really starting to show some constructive trading action. And one of those is with the space theme, and one stock I want to keep an eye on is with AST Space Mobile, ticker ASTS. Now, there's a couple, there's some things on this chart you really need to pay attention to. One is that the prior rally, again into October, is when we saw a lot of these names peaking out. For ASTS, that took it right up to this 100 level. That round level can be a psychologically important level for investors. So keep that in mind. Here now we've seen some constructive trading action come into play. So we had this initial dip, this initial pullback into the end of November, start of December. Now we've rallied right back up toward the prior highs, but you can see we're making a series of smaller pullbacks along the way. So the smaller pullbacks can help point to accumulation that's happening in the share price. And so now we're right back to this $100 level. So keep a close eye on ASTS this week. And if it can break out above that $100 level, if it does, you want to see rising volume on the breakout along with the relative strength line confirming at new all-time highs. So watch that with ASTS in the coming week. All right.